Hi, it's Monday, August 28th, 2023. Hope you're doing great. Welcome to today's live stream. So, what you're seeing here is the US Treasury's yield curve from August 24th. And if you notice, the upper level rate is 5.6%. Do you see that right there? 5.6 upper level on the graph. So, what you're seeing here is a continued inverted yield curve. 1 month short term, 1 month, 2 month, 3, 4, 6 months, 6 month rates are, and all the way to the 5 year. So everything on the short and intermediate term yield curve is higher than long-term rates. See that? 20-year at 4.49, 30-year at 4.3. So we go out short term, 5.69 for 6 month rate, and the 3 month rate at 5.58. Now, if I advance to the next day, the 25th, it looks like the rates dropped, didn't it? Do you see that? Let me go back. Watch the yield curve on the short term. It looks like they've dropped. But what happened is they've gone up because now they've introduced 5.8% on the short end. So let me go back. August 24th, you see the 6 month rate is 5.59. All right. The next day, the 25th, 6 month rate is 5.61. So the short-term rates continue to increase, which does two things for you as an investor. Number one, it makes your fixed income assets go down in value. So fixed income is anything like a bond, a CD, a treasury bill, anything that has a fixed rate to it, a GIC. So as interest rates continue to go up, the values go down. It's called an inverse relationship. And I've talked about this in the past, but I want to revisit this because it continues to happen. But if you look at lamestream America, the lame messaging media, they're saying continue to buy bonds because they have to say that because governments, companies, municipalities issue these bonds to stay afloat, all right, to expand their business, whatever their reasoning is. So they issue these instruments that are guaranteed to go down in value as interest rates continue to go up. Now, we know interest rates are going to keep going up because they've already expressed that, right? They've already said that rates are going to continue to rise because of the fact that inflation still isn't under control. Why they think that increasing interest rates helps with inflation makes zero sense to me, but none of this makes sense. This is an upside down situation here. So that's the first thing. As interest rates go up, it's going to affect your purchasing power, your buying power, but also it's going to affect your portfolio because most people have fixed income in their portfolio without even realizing. If you have an asset such as a balanced mutual fund, it'll say the word balanced right in the title of the mutual fund. Balanced corporate bond portfolio or fixed rate, some of them will say fixed rate asset, and it'll be under the fixed income portion of your statement. The best thing you can do is get out of these investments. I've been saying this for a few years now because interest rates will continue to go up and the value of these investments are guaranteed to go down. So the better option for you are dividend paying stocks. First of all, you're going to get a better current return from your dividend paying stock than you would a mutual fund. And you're going to have the good fortune of that dividend paying stock to go up in value. So that's the first thing to consider when we're looking at these interest rates continuing to rise. And then we need to look at the effects personally. Personal loans are masking Americans' credit card problems. I think I introduced last week or the week before that, we're now over $1 trillion in credit card debt. North America, 1 trillion. It's the highest level it's ever been. So what's happening is folks who turn to personal loans to manage outstanding balances on credit cards are finding themselves back in card debt months later. Big surprise, right? So there was a survey. TransUnion is one of the big three credit agencies in the U.S. And what happened was, if you all recall back in what's been going on for about 15 years, this consolidation of credit card debt, all right? They kept putting offers out there for people to consolidate their high interest rate credit card debt with a lower interest rate. And that was either a personal loan or a HELOC, right? A HELOC, which is a home equity loan. It's still a line of credit. And I don't know the exact numbers, but it was massive how many people have done that. But the problem is those balances, that was to buy you a little bit of breathing room where you could pay that debt off. So initially, they found that borrowers who used a personal loan to consolidate their credit card debt saw their balances decrease by 57% on average. So yes, the credit card balances went down because there was another form of credit that paid off those credit cards. But those balances returned close to their previous levels 18 months later. So what this is saying is, even though consumers used that line of credit, a personal line of credit, to pay off the credit card, they ran the cards back up. Interest rates remain north of 20%. Delinquencies are starting to tick up. So what needs to happen here is people need to take some type of financial course or understanding, or work with a debt consolidated. Don't work with a debt consolidated company because they charge exorbitant fees. Start practicing discipline with your money. Now, I'm sure none of this won't apply to many of you here, but you might know of someone who all they do is just, live on credit cards, and because they're not making ends meet. And the best thing you can do is encourage them to start doing their best to live within their means. I'm sure, they could probably go through their household and find things that either they're not using or their kids aren't using anymore and sell it. Just get cash for it and save that money. Don't spend it, but put it toward credit cards. The highest interest rate, just go through. You need to make a little spreadsheet of your credit card debt. I know when I was a real estate investor, I had hundreds of thousands of dollars for lines of credit, credit cards, mortgages. I mean, it went into the millions because I owned a lot of real estate. And I had to actively manage that with a spreadsheet. So every month I tracked it, which interest rates were the highest. When I sold a property, those got paid down first. And then the other ones I just kept clipping away at. So what gets measured and monitored gets dealt with. So the key now is not to turn a blind eye. The key is to lean into what you've got, right? All your assets that are either costing you money or making you money. The idea is that stocks put money in your pocket. They grow in value. Debt will always be that kind of ball and chain around your ankle that needs to be eliminated. So I just wanted to bring this to everyone's attention, that this Treasury yield curve is going up, although it looked like it was going down. So these rates are going higher on a week-by-week basis. and it's causing valuations to drop in your portfolio. It's causing it's eroding the purchasing power of money, and it's just not a positive thing. So consider, getting all this stuff paid down. Very important. Before I get into the stock rocket of the week, I want to talk about our company, Sterling Stock Picker, and our expansion that we've made over the last few years. We rolled in the teaching platform that was previously called Stocks for Freedom. And so now we've rolled that into Sterling Stock Picker, and now we are going in the direction of working with businesses as an offering in their wellness program. We are looking to fill that piece of the financial wellness, to deliver financial wellness to employees. So if you have any connections or companies that you work for that would be interested in talking with us, please let us know. I'm going to put the link to here at sterlingstockpicker.com//business, and they can download our guide for financial well-being, employee financial well-being. It's packed with good information and ideas for them to consider. They just have to fill this out. Probably would apply to anyone in HR or any executive that would make some type of decision around employee benefits. Probably the best one for that. Okay, and we appreciate any leads that you would give us. We're tracking those down on a daily basis. All right, here is the stock of the week. It is Clearwater Analytics Holdings. Just like us, it's a SaaS company, software as a service. And it provides really, really interesting metrics and valuations for, here we go, government. They're a solution for automated investment data aggregation, reconciliation, accounting, and reporting services to insurers, investment managers, corporations, institutional investors, and government entities in the U.S. and internationally. So they're headquartered in Boise, Idaho. They've got a full range of products that they have available. Here's their website. Really interesting company. I think they're well poised for growth here. We do have a buy rating. It is high risk, so you would need to make sure that your risk category is in the high range. But stock chart looks terrific. We've got the price above all of the EMA and SMA. We've got the MFI at 62, so in the sweet spot. And I found this company from our homepage. I found it right here. This is the Magic Stock Selector. So I just click through and up popped that company. There it is. Clearwater Analytics Holdings, Inc. I'll mark it at $17.58, which is the price right now. Have a fantastic week. Thanks for your support. Thanks so much for sharing our software with your friends and family. And I look forward to continuing to grow our platform. Our new website portal is going to be launched on September 8th. So September 8th, not far from now. We'd love to get your opinion and hear your feedback. Thanks so much. Have a great day.